On January 30th, 2026, silver lost $51 in a single trading session. From $121 all the way down to $70, $51 gone in hours. Not a slow bleed, not a gradual correction. A cliff? The largest single-day collapse in silver since 1980. Analysts called it a 6 sigma event, a statistical impossibility. Over $7 trillion evaporated from global markets in 48 hours. Retail traders were getting margin called into oblivion. Bullion dealers from Dubai to Switzerland had zero silver left on their shelves, zero inventory. And while the entire world was panicking, while thousands of traders were watching their accounts get liquidated in real time, one man was sitting on the other side of that trade, calm, calculated, profitable. Nobody knows his name. He does not give interviews. He does not respond to emails. He operates out of a tiny office in Gibraltar, far from Wall Street, far from the City of London, far from any financial spotlight. And on that exact day, he was holding the single largest short position in silver on any exchange on the planet. 30,000 contracts, 450 tons of physical silver equivalent. His paper gains from that single bet, according to Bloomberg, published February 5th, roughly $288 million. Net profit, after accounting for his earlier losses, around $144 million. 1 billion yuan from one trade. But here's why you need to keep watching. This story is not about one mysterious billionaire getting rich. What happened on January 30th, what happened on February 5th, and what is still unfolding right now as I record this, reveals a fracture in the silver market that I genuinely believe could reshape the entire precious metals landscape. And what I am about to show you later in this video about what really happened on February 5th, the trading volume data that came out of Shanghai that morning, is something almost nobody is covering. It might be the single most important data point in the commodity market right now. And I will also reveal exactly who this man is, how he built his fortune, and why his identity changes everything about this story. By the end of this video, you will understand exactly why. Welcome to the Hidden Economy. Subscribe if you are new here. Hit the like button. It takes 2 seconds, and it genuinely helps more people find this kind of analysis. Now let us get into it. Every financial outlet from Bloomberg to CNBC ran the same headline last week: silver crashes. Gold dumps. Warsh nomination shakes markets. And here is the part they conveniently left out. According to CNBC, silver futures on the COMEX plummeted 31.4% in a single session. The worst day since March 1980. Spot silver fell 28%. Gold dropped about 9%. Now stop and think about that ratio for a second. Silver fell 3 times harder than gold. 3 times. If this was purely about the dollar strengthening and interest rate expectations, why would silver collapse 3 times more than gold? They are both priced in dollars. They both respond to the same macro forces. But silver got absolutely obliterated while gold had a rough afternoon. That asymmetry is the tell. That is the part nobody is explaining properly. And once you understand why, you will never look at a silver price chart the same way again. Here is the mainstream version of events. On January 30th, President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is seen as a monetary hawk. Markets interpreted this as higher interest rates for longer. The dollar surged, and because precious metals are priced in dollars, gold and silver collapsed. Simple supply and demand of currency expectations. Case closed. And that narrative is not wrong. It is just about 10% of the actual story. The other 90% is what makes this one of the most important moments in the silver market since the Hunt brothers in 1980. And I do not say that lightly. What actually happened underneath the surface was a coordinated liquidation of leveraged positions combined with aggressive short selling. And the data backs this up completely. CFTC positioning data showed speculative net longs in silver were near record levels heading into that week. The entire market was leaning in one direction harder than at almost any point in history. Then the trigger came. According to Morgan Stanley, their quant desk flagged what they called massive forced rebalancing in leveraged silver ETFs. The iShares Silver Trust alone had $3.5 billion in forced selling on January 30th. $3.5 billion from one fund on one day. And then CME Group poured gasoline on the fire. They raised margin requirements on COMEX silver futures from 11% to 15% during a sell-off. Think about what that does mechanically. When you hike margins in a crash, every leveraged trader who cannot meet the new requirement gets forced liquidated. Their positions get dumped into a falling market. The price craters further. More margin calls trigger. More liquidations cascade. It becomes a self-reinforcing death spiral. And this is exactly the environment in which our mystery man had positioned himself. Now let me show you exactly how he did it. I told you at the beginning of this video that one man was sitting on the other side of this crash, that he does not give interviews, that he operates out of Gibraltar, that he made $144 million in a single trade while the rest of the world burned. Now, let me tell you who he is. His name is Bian Ximing. And once you hear what this man has done over the past 4 years, you will understand why his involvement in this silver crash changes everything. Bian Ximing is a Chinese billionaire who has made over $3 billion going long gold on the Shanghai Futures Exchange since 2022. $3 billion on gold. Over 4 years. He is one of the most successful metals traders alive. He made billions riding metals up, and now he just made hundreds of millions riding silver down. According to Bloomberg, published on February 5th, 2026, Bian has been building short positions in silver through his brokerage, Shanghai Futures, on the Shanghai Futures Exchange. Exchange data shows that Zhongkai's silver short position surged to about 18,000 lots on January 28th. That was 2 days before the crash. By January 30th, the exact day silver hit its all-time high in Shanghai, his position had climbed to roughly 28,000 lots. Let me say that again. On the exact day silver peaked, he added 10,000 more short contracts. His total position reached approximately 30,000 contracts, equivalent to 450 tons of silver. Now I want to be very careful here. I'm not saying Bian caused the crash. I'm not saying he had inside information about the Warsh nomination. What I am saying is that this man, who made $3 billion being right about gold over 4 years, made a massive directional bet against silver at the exact right moment. And the timing is almost too perfect. According to Bloomberg's analysis of the exchange data, he started building this position back in November 2025, trying to catch the top. He took losses on some early attempts. In fact, he had actually been long silver before that. Back in August 2025, his long silver trades earned him over 1.3 billion yuan. So he made money going up, then flipped his entire position and made money going down. My honest take on this, and I have been thinking about this all week, is that Bian simply read the market correctly. Silver had gone parabolic. It went from around $30 in early 2025 to over $121 by January 29th. That kind of move, a 4x rally in under a year, is historically unsustainable regardless of what the fundamentals say. I have seen this pattern before with other commodities. When something goes 4x in 12 months, the leverage that builds underneath becomes a ticking time bomb. He saw the speculative excess. He saw the leverage stacking up to dangerous levels, and he bet that gravity would eventually win. And it did. But here is the part that genuinely keeps me up at night. One trader, operating through a single brokerage, holding the largest net short position on the entire Shanghai Futures Exchange. He manages personal trades and select client portfolios, all stacked into this same bet. And he profited massively, at least $144 million, while the rest of the market burned around him. Some estimates from Cryptopolitan put his total gains even higher, closer to 500 million. Tell me in the comments if you think that timing was pure skill or if something else was going on, but do not answer yet, because what I am about to show you about the physical silver market makes this entire situation 10 times more disturbing. While COMEX silver was crashing to $70, something completely different was happening in the physical market, and this is the part that genuinely made me sit back in my chair and rethink everything I thought I knew about how commodity markets are supposed to work. I have been covering precious metals for years now. I have seen disconnects. I have seen volatility. But I have never seen anything like what happened on February 2nd. According to data compiled by multiple analysts and confirmed through exchange pricing, on that day, the same ounce of silver was trading at completely different prices depending on where you were standing on the planet. In New York, on the COMEX, silver was around $80. In Japan, that same ounce was going for $120, 80 versus 120. Same metal, same day. A 50% difference, and it was not just Japan. Shanghai Gold Exchange, $111. India, 93. Kuwait, 106. Dubai, 91 with a 15 to 18% premium over spot. Every single major market on Earth was pricing silver differently. According to financial analyst Shanaka Pereira, this represents, and I am quoting him here, the largest sustained divergence in precious metals history. Let me just repeat that. The same metal, the same ounce, the same chemical element, 40% different prices depending on which market you look at. In a functioning market, that kind of spread should not exist for more than a few minutes. Arbitrage traders should buy cheap in New York, ship to Shanghai, and close the gap. But that is not happening. And the reason it is not happening, according to analysis published on Trading Key, is that silver lease rates have surged to around 7 to 8%. When you factor in those borrowing costs, plus freight and insurance, the arbitrage opportunity is economically dead. You simply cannot profit by moving metal from west to east anymore. The system that is supposed to keep global prices aligned is broken, and it gets worse. When I went and checked the data myself from the Khaleej Times, published January 31st, I found that physical silver bars were completely unavailable in Dubai. Traders told the paper that stock was exhausted and buyers were paying 2,000 dirhams per kilogram above market rate just to secure metal. One dealer named Amar Akrami from Al-Manar Gold and Diamonds was quoted saying, "Silver is not available in the market right now." I also came across reports that one of the largest bullion dealers in Switzerland, according to industry insider Clive Thompson, had zero silver in stock. Not low stock. Zero. No replenishment for weeks. When silver did come in from customers selling it back, it was sold instantly. Nothing left for new buyers. And their gold situation was nearly as bad. Completely sold out of all coins and small bars. Only the large 250 gram, 500 gram, and 1 kilogram gold bars remained. Now I need you to connect these dots with me because this is critical. COMEX says silver is worth $80. Shanghai says it is worth over $100. Dubai says you cannot buy it at any price. Switzerland says there is literally none available. And the paper to physical ratio on COMEX is estimated at around 350 to 1. That means for every real ounce of silver being traded, there are 350 paper claims on it. I want you to sit with that number for a second. 350 pieces of paper for every 1 real ounce. You and I both know that does not add up. And what happened next made the math even worse. Now let me show you what happened on February 5th, because this is where it gets truly extraordinary. And I mean that in the most literal sense. This is the part of the story that almost nobody is covering, and I genuinely do not understand why. According to Shanghai Futures Exchange data, on the morning of February 5th, 1,396,553 contracts were traded on the April 26 silver futures contract alone. Let me put that number in perspective for you. Each SHFE silver contract represents 15 kilograms of silver. When you calculate the total, that single morning session represented approximately 674 million ounces of physical silver equivalent. And when you add in all the other silver contracts that traded that morning, the total comes to approximately 1.34 billion ounces. Now remember this number. The entire world mines roughly 800 to 850 million ounces of silver per year. So in one morning session on one exchange, they traded the equivalent of nearly double the entire annual global mine supply. When I first saw this number, I did not believe it. I thought it was a typo. I went and cross-referenced it with the SHFE contract specifications myself. 15 kilograms per lot. I did the math 3 times. It checks out every time. One analyst called it the most incredible thing in the history of commodity markets in Asia. And I am inclined to agree. This was not retail traders pushing buttons on their phones. This was not normal market activity. This was a massive, deliberate short-selling attack designed to crash the Chinese silver price. And here is what fascinates me about it. You know what happened? Even after all of that selling pressure, every single one of those 1.34 billion paper ounces being dumped on the market, Shanghai silver still closed at a significant premium to COMEX. The price was beaten down, but the premium survived. Silver in Shanghai was still trading above $102, while COMEX was around $77. The Shanghai premium went right back to $17 per ounce, and silver remained in backwardation, which means near-term delivery costs more than future delivery. That signals physical tightness that no amount of paper selling could resolve. The paper games could not break the physical reality. I find that incredibly telling. And honestly, this is the moment in my research this week where everything clicked for me. You can dump a year and a half worth of global mine supply onto a market in one morning, and the physical premium still will not die. That tells you something profound about where the real power lies in this market. It is not with the paper traders. It is with whoever holds the actual metal. Now let me bring in another critical data point that adds to this picture. According to CEIC data, physical silver inventories at the Shanghai Futures Exchange have been falling sharply, from roughly 482 tons down to 455 tons, and then from 449 tons on February 3rd to 423 tons on February 4th. That is a 26-ton drop in a single day. And for historical context, SHFE silver inventories peaked at over 3,091 tons in January 2021. They are now at 423 tons. That is an 86% decline from the all-time high. The silver is physically leaving the warehouses. This is not paper. This is real metal being taken off the exchange. And China's industrial demand, solar panels, electronics, high-tech manufacturing, is consuming it faster than it can be replaced. And this brings me to the structural picture that makes the January 30th crash so paradoxical. Because if you just look at the headlines, you would think silver is done, bubble burst, story over, pack it up. But the fundamentals are screaming the exact opposite. And this is where I want to share my personal perspective because I think it matters. I have been tracking silver's supply-demand dynamics for a long time now, And what is happening right now is unlike anything I have seen in my career covering commodities. On January 1st, 2026, the Chinese government officially reclassified silver as a strategic resource. This is a massive deal that most financial media completely glossed over. Only 44 companies received authorization to export silver for 26 and 27. This covers approximately 121 million ounces of annual exports, which represents 60 to 70% of all refined silver traded globally. Think about what that actually means. China is the world's largest refiner of silver, and they just put a government chokehold on supply leaving the country. You do not reclassify a commodity as strategic unless you plan to keep it for yourself. I have been saying this on this channel for months. When a government starts hoarding a commodity, when they start restricting exports, that is the clearest signal you will ever get about where they think the value is heading. On top of that, Samsung, one of the largest technology conglomerates in the world, locked up 100% of the output from the La Parrilla silver mine in Mexico for the next 2 years through a direct $7 million prepayment deal. Samsung did not go to COMEX to buy paper silver. They did not buy an ETF. They did not touch the futures market. They went directly to the mine and said, "We want every single ounce you produce for the next 2 years." When a company like Samsung bypasses the entire exchange system and goes straight to the source, that tells you everything you need to know about what sophisticated industrial buyers think about future silver availability. They are bypassing the paper market entirely because they do not trust it to deliver. And that right there is the key insight that I keep coming back to. The smart money is not playing in the paper market anymore. They are going directly to the physical supply. And I want to pause here for a second because I need you to really absorb what I just told you. A government is hoarding silver, a mega corporation is locking up entire mines, and the exchanges where the price is supposedly set, nobody trusts them to actually deliver the metal. If that does not make you rethink how this market works, I do not know what will. And here's the timeline problem that nobody in mainstream finance wants to discuss. Even at today's elevated prices, any new silver mining project takes 7 to 10 years to come online. The supply response to current demand will not arrive until 2033 at the earliest. The supply curve is essentially locked for the next decade. Meanwhile, silver has been in a structural supply deficit for 6 consecutive years, and the deficit is not getting smaller, it is getting larger every year. Demand from solar panels alone consumed over 200 million ounces last year. Electric vehicles, artificial intelligence data centers, 5G infrastructure, medical devices, they all need silver. And there is no substitute. You cannot swap silver out of a solar panel. The physics does not allow it. Even the state of Wyoming, according to a press release published on February 3rd, just selected the Wyoming Reserve to vault its physical precious metals holdings. A United States state government is now actively securing physical gold and silver storage within its own borders. When state governments start vaulting precious metals, that is not a normal market signal. That tells me something fundamental has shifted in how institutions view these assets. So let me give you my honest assessment on where this all leads. I'm going to acknowledge the bear case first because I think intellectual honesty matters, and then I'm going to tell you exactly what I think is actually happening. The bear case is straightforward. Kevin Warsh, as Fed chair, means higher rates for longer, stronger dollar pressures metals. Silver went parabolic too fast and needed a correction. JP Morgan analysts have warned silver could revisit $50, and Bian Shiming, a man who has made $3 billion on metals, is actively shorting it. If he sees downside, you should at least consider the possibility. And yes, the volatility is real. Silver crashed $51 in a single day. If you're leveraged, you can get wiped out in hours. I'm not going to sugarcoat that. Now here's where I break from the bears, and I am going to be very direct about this because I have spent the entire week buried in this data, and I have a strong view. The crash on January 30th was a leverage event. It was not a fundamental event. And there is a massive difference between those two things. A leverage event means the price moved because of how people were positioned, not because of what the asset is actually worth. And every single piece of physical market data confirms this. Physical silver in Shanghai held above $100, even during the worst of it. Physical silver in Dubai was unavailable at any price. Physical silver in Switzerland literally did not exist on dealer shelves. The paper price said $80. The physical market said you cannot have it at $100. That is not a bear market. That is a broken pricing mechanism. And the fundamentals behind that physical tightness have not weakened since the crash. They have gotten stronger. Silver is in a structural deficit with no supply response possible for 7 to 10 years. China restricted exports as of January 1st. Industrial demand from solar, artificial intelligence infrastructure, and electric vehicles is accelerating every single quarter. COMEX inventories lost 26% of registered silver in 7 days. LBMA London holdings are down 40% since 2021. Silver lease rates exploded from 0.5% to 8% and have not come back down. That is not a market that just had its bubble popped. That is a market where the physical metal is genuinely running out while the paper market pretends everything is fine. And here is the macro picture that makes me even more convicted. Goldman Sachs has a $5,400 gold target. Bank of America has floated $6,300. JP Morgan itself forecasts gold at $6,300. And silver historically does not stay at a 55-to-1 ratio with gold when gold is in a secular bull market. If gold goes to 6,000 and the ratio compresses to 45-to-1, silver goes to $133. 40-to-1, $150. My personal view, and I want to be clear, this is opinion and not financial advice, is that we are looking at one of the most asymmetric setups I have ever seen in commodity markets. The risk reward for the patient physical holder versus the leveraged paper trader is not even close. The paper market can manipulate the price in the short term. We just watched it happen in real time. But it cannot create physical silver out of thin air. And eventually, always eventually, physical reality wins. It always does. So let me leave you with this. The paper silver market says $77. The physical silver market says you cannot buy it at 100. One of those numbers is lying. And in the history of commodity markets, when paper and physical diverge this far apart for this long, it is always paper that eventually tells the truth. Now I want to hear from you. Where do you think silver is heading by the end of 2026? Does the paper market win, or does physical reality take over? Drop your price target in the comments right now. I read every single comment on this channel, and I will pin the best analysis I find. If you got value from this breakdown, share it with someone who needs to see it. Send it to your group chat. Post it on X. Get it in front of people who are still confused about what just happened in the silver market. And if you want to support the work I do here and keep this kind of independent analysis coming, join my channel. This is The Hidden Economy. Because the real story is never on the surface. I will see you in the next one.